All right, so in this section, we're going to talk about something called national income accounting. So if you've taken an accounting class, you might have thought about how at the end of the last video, you might have been reminded of accounting, because accounting always involves two transactions, right? There's two aspects to every single transaction. And you were absolutely on the right track if you thought that way. But basically, the national income accounting is a system used to estimate national income and its components. So it's kind of the way that we estimate economic activity in the country. And when we estimate the economic activity in the country, that total activity is called gross domestic product. Okay, and it's basically just the total market value of all final goods and services that are produced by the factors of production within a country's borders. So we will talk briefly about something called gross national product, and it's slightly different. It is the market value of final goods and services produced by factors of production that a country's citizens own, regardless of where they are or where the production takes place. But the most common measure of economic performance is GDP, gross domestic product. So anything that happens within the borders of the United States, any production that takes place within our borders is going to be part of GDP, as long as it's a final good or service. So what we need to observe is that gross domestic product measures the dollar value of final output. Okay, so it's a measurement of the dollar value of final output. It measures the dollar value of final goods and services produced by the factors of production within a country's borders, right? And it's usually expressed in per year terms, so in a given year. Sometimes it's expressed in per quarter. There are quarterly reports, so 4 times a year on GDP, but generally it's measured in per year terms. Okay, so we need to be careful here and put some stress on final output, right? So let's make sure we understand what final means. What is a final good? So is wheat a final good? Do you purchase wheat at the store? Do you purchase steel? Do you purchase crude oil? Right. Hopefully your answer was no to all of these. None of these are final goods. Okay. They are intermediate goods. They will be transformed into things that we do buy, things like bread, right? So bread is a final good. Automobiles, which are made out of steel, are final goods. Gasoline, which we purchase, is a final good, which is made from crude oil, right? Now, it doesn't mean that these things, bread, automobiles, and gasoline, are always final goods. I'm really looking at bread in particular, right? So Subway buys bread as well. Well, they might make it actually, but in any case, let's just assume Subway buys bread, right? In that case, it's not a final good or service because that bread is still going to be transformed at Subway. It's going to be transformed into a sandwich. And in that case, the sandwich is a final good. Okay, but hopefully you're getting the idea here of what a final good is or a final service. It's basically whatever consumers buy, right? Things that consumers buy are final goods. Okay, things that companies buy are intermediate goods. They're not final. They need to be further transformed so that they can be turned into something that consumers want to buy. Right. And so, like I said, intermediate goods are goods that are purchased by businesses that are used up entirely in the course of production, and they are transformed into final goods. Okay. And this basically is companies are taking intermediate goods and adding some value by transforming them into final goods. Right. And so that's what this value added concept is. It's the dollar value. You can calculate it as the dollar value of an industry's sales minus the value of intermediate goods, right? So if Subway sells you a sandwich for, let's say, $5. They sell you a $5 footlong. That would be the value of their sales. And then you would take away the cost that it cost them. What did it cost them to make that sandwich? If it cost them $3 in materials and labor to make that sandwich, then they basically added $2 of value to those materials, right? And that's the idea of value added. So we would take $5, the sales value, subtract the cost of the value of intermediate goods, $3, and the difference there, the $2, is the value that they added to those materials. And that's what value added is. So here's an example of value added, right? A numerical example. So we start off, we have different stages of production. We start off with fertilizer and seed, and those are, the value of those are 3 cents, right? The fertilizer and seed is 3 cents. And so the value added is 3 cents. And we're talking about the production of a donut here, by the way. The next stage is growing the wheat, right? So growing the wheat is grown and sold for 7 cents. Let's see here. Let me make sure I got this right. The wheat is sold for 7 cents. And the materials used in growing that wheat were the fertilizer and seed, which cost 3 cents. And so the value added in stage 2 is 4 cents. Now, the next stage is milling the wheat. And the milled wheat sells for 12 cents. And it was the wheat before it was milled was purchased for 7 cents. And the difference there is 5 cents. So the value added in stage 3 is 5 cents. And so on until we get all the way to the end where the donut is sold for 45 cents. Okay, so now the interesting thing is that if you add up all of the value added in column 3, it equals 45 cents, which is the final retail sale of the donut. And so that's actually one of the ways to calculate GDP is the value added approach. And that's exactly what that would be, but you're not responsible for knowing that way of calculating GDP. We're going to focus on the expenditure and income approaches. But that's basically what the value added approach is. All right, so there's the story if you want to go over it yourself. Now we have to be careful here because we don't want to add up all of the values of sales, right? The total dollar value of all sales is 97 cents. And so we'd actually be double counting if we did it that way. It would give us an inflated value of the donut. The value of the donut is 45 cents because that's what it sells for in its final stage. And so anyway, just be aware of that.